Hello, everyone, and welcome to our podcast where we dive into the world of energy, trade, and shipping. I'm your host, Trisha, and today we have an insightful discussion lined up. Joining me is our esteemed guest, Sandesh, a seasoned expert in energy markets. Welcome to our podcast, Sandesh.
Hi Trisha, thank you for having me. I am excited to be here and share my thoughts on this fascinating topic.
So let's jump right in. Now, Sandesh, we know that the global oil refining industry is undergoing significant changes, with profitability and demand facing major challenges. So, could you start by explaining why refining margins have collapsed recently?
Absolutely, Trisha. The collapse in the refining margin is tied to several factors, and let me break it down simply. In the past few years, we saw refining margins, particularly the 3-1 crack spreads. They hit extraordinarily high due to supply disruptions and geopolitical events. But by 2024, these margins returned to pre-pandemic levels. If I have to give an example, European 3-1 crack, it dropped from $23 per barrel in 2022 to just around $16 per barrel in 2024. So the main reasons: first, demand for refined products like gasoline and diesel, they are slowing down, especially in the developed regions like Europe. And there are some other factors also. Those factors include economic headwinds, biofuel mandates, and at the same time, the increasing efficiency of engines. So that was the first. And second is new refining capacities. They have come online in places like Nigeria and China and even in Mexico. And they are kind of a modern and highly efficient infrastructure present in the market. So these facilities, they produce more at a lower cost, and they're adding a pressure on older refineries, specifically in the Europe and the US, because these refineries are old. So lastly, the global energy transition is reshaping the market. Electric vehicles, for example, are reducing the demand for gasoline. Now, talking about China, China is a key driver of oil demand, and Chinese economies, they are rapidly adopting EVs. Currently, they have around 46% of their auto sales. Is it either being electric or hybrid? And this is about the 2024. This combination of weaker demand and rising supply, they are squeezing margins, and they're forcing many refineries, especially in Europe, to cut operations or even shut down entirely.
So, with these structural changes that you rightly mentioned, how do you think are refiners adapting to remain competitive in the market?
Great question, Trisha. Adapting to this environment is challenging, but refineries are employing a few strategies. And I like to mention here first, many refineries, they are now focusing on modernization, because modernization gives you two benefits. One is cost benefit and other one is environment benefit. So refineries in Asia and the Middle East, they are leading here in the modernization segment, and with the state-of-art facilities that are more efficient and even kind of environmentally friendly. So, for instance, the Dangote refinery in Nigeria, they started operations in the mid 2024. It was a game changer. It's massive. They were highly efficient and strategically located to serve both local and export markets. They have not yet fully started their operations on a full scale basis, but eventually they will start, and then it will be a game changer in the market. Now, in contrast, older refineries, those are present in Europe, they are struggling. We know that those are some of the older and smaller refineries, but they are kind of a struggling. So some are converting to even biofuel plants or terminals to stay relevant. They are converting their empty tanks into storage and terminals. So, for example, Petroineos is turning its Grangemouth refinery into terminal, and then we have a Shell. They were also shutting down older units in Germany. So, secondly, if I have to mention, there is a shift towards biofuel and cleaner energy. The Europe is leading this charge with biofuel mandates, and it is now accounted for 10 to 15% of the fuel mix. And it is specifically in many markets, but uh, when we say about Europe, it is around 10 to 15%. But however, these changes, they are costly and they require significant investment. And lastly, my opinion is that many refineries are exploring niche markets. So instead of competing in oversupplied regions, They are targeting kind of emerging markets in Africa and Latin America where demand is still growing. But let's be clear, these are the not long-term solutions. The structural decline in fossil fuel demand will continue, and only the most efficient and adaptable refineries will survive in the long term.
Fascinating insight, Sandesh. Now, let's talk about geopolitics since it's always a hot topic in the shipping industry. So, could you tell us how does geopolitical tensions and different policies they influence the refining and the shipping markets?
Geopolitics and oil, they are always going with hand in hand. In last 50, 70 years, we have seen and we have kind of have very good evidence of that where oil and geopolitics have play a very key role with each other. And in my opinion, geopolitics always play a significant role in the energy markets. And in 2024, we saw several key developments. And for instance, Russian diesel export hit record highs despite sanctions. How? Russia invested heavily in new refining units to upgrade heavy fuel oil into diesel. And then they rerouted exports to countries like Turkey and Brazil. So, this reshuffling, they disrupted traditional trade routes and at the same time, they impacting tanker markets as well. So, Middle East, the tensions in the region, such as Houthi attacks, they are near the Gulf of Aden and it forced tankers to reroute around the Cape of Good Hope. Now, they added some of the weeks to transit times, and I mean, it's depend upon where you are traveling. So, while this temporarily boosted freight rates and ton miles, the overall impact on refinery margins was limited due to oversupply. So yes, policies also matter in terms of oil business and oil trade, even in the energy scope. So in Europe, there are some of the stricter emission rules and ICE bans. This is ICE means internal combustion engines. So we have seen ICE bans in Sweden. So they are accelerating the shift to cleaner energy and it putting pressure on refineries. And meanwhile, countries like Sweden, they are rolling back some green targets. They are creating mixed signals for the market. So this geopolitics and policy factors create uncertainty, but it makes harder for refineries and shippers to plan for the future.
Very rightly said, Sandesh. Now, earlier you mentioned the impact of EV adoption and biofuel mandates. So, could you tell us how are these trends reshaping the traditional refining business model?
Absolutely, Trisha. The adoption of EVs or electric vehicles and the increasing use of biofuels, they are reshaping the traditional refining business model in profound ways. So let me break it down. First, let's talk about the EV adoption. And I have to give you some stats here. So globally, EV sales are surging. In 2024, we have seen nearly 14 million EVs were sold, which is double the number sold in 2021. And China, they lead the charge with EVs making up almost 46% of total auto sales, which I have mentioned earlier. And along with that, Europe is also seeing significant growth, while other regions like North America, they are also started catching up. And this rapid adoption of EVs, they are directly impacts gasoline demand, and it is kind of a traditional or traditionally been a cornerstone of a refinery output. For example, if I have to say in China, gasoline demand has already peaked at around 3.6 million barrels per day and is now on a downward trajectory. So the same pattern is emerging in Europe, where the push for decarbonization and then bans on internal combustion engines, these are accelerating the shift. Now, coming on to the biofuels, the governments worldwide, they are mandating higher biofuels blending to meet their climate goals. In Europe, we have a E10 gasoline blending, then we have a B7 diesel blending. So these are kind of a standards. They are now available in many countries. And the US has embraced E15 gasoline, and at the same time, China has also significantly ramped up the biofuel production in order to achieve the same. So while this is a great for reducing carbon emissions, it presents a challenges for refineries. Now, refinery is in a dilemma whether to increase gasoline production because domestic gasoline consumption is declined, or what a significant alternate approach they have to take. So the challenges persist for refineries. So every gallon of biofuel blended into the mix reduces the demand for traditional fossil fuels. So refineries that aren't equipped to produce or handle biofuels are finding it kind of a harder to compete. And these trends, they are forcing refineries to rethink their business models. Many of what they are started investing in renewable fuels like biodiesel, renewable diesel, and sustainable aviation fuel. So others are pivoting to petrochemical production where demands remain strong. Having said that, there is a challenge. Transitioning to these new models, they require a significant investment, and not all refineries can afford it. Smaller or older facilities, particularly in Europe, they are shutting down or converting to biofuel plants. And meanwhile, newer or more efficient refineries in Asia and the Middle East are capturing the market share.
So, Sandesh, now that we're talking about traditional fuels, with demand for these traditional fuels declining, are there any regions or markets where demand is still growing?
While demand for traditional fuels, they are declining in mature markets like Europe and North America. There are still regions where demand is quite growing, and it was specifically driven by three important factors, and that includes economic development, population growth, and industrialization. So, if I have to give an example, let's start with Africa. This is a region where energy demand is kind of on the rise due to urbanization and growing middle class. For instance, if I were to point out one specific country, in Nigeria has been historically one of the largest importers of refined products, particularly gasoline. And even though the Dangote refinery, which started operations in 2024, this particular refinery is designed in such a way that it can get domestic crude, refined it, and supply it to domestic markets. So, what that said, that says that it will reduce Nigeria's reliance on imports. The broader region continues to see the increasing demand for transportation and industrial fuels. So the other parts of sub-Saharan Africa, they are also expanding their infrastructure, and that drives diesel and gasoline consumption. So that was about Africa. Then next in line is Latin America. So while some countries in the region, they are exploring renewable energy, the traditional fuels still dominate. So we have countries like Brazil and Mexico. They are seeing steady demand for refined products, and specifically Mexico, for example, it relies heavily on imports from US. And what it need Mexico, for example, it relies heavily on imports from the US Gulf Coast, and they required it to meet their domestic fuel needs. So, as their economies grow and vehicle ownership increases, the subsequent demand for gasoline and diesels will continue to remain strong. Finally, there is Asia, particularly in countries like India and in the parts of Southeast Asia. So India is a standout example. We know why. With a rapid growing population and increasing industrial activity, the vehicle ownership is rising, and while there is an interest in EVs, the adoption rate is much slower compared to China or Europe. So this means traditional fuels like gasoline and diesel will continue to play a significant role in coming years. So in Southeast Asia, the countries like Indonesia, then Vietnam and Philippines, they are also experiencing growth in fuel demand. So these nations, they are heavily dependent on imported refined products. It creates opportunities for export-oriented refineries in the regions like Middle East and India. So that said, even in these growing markets, the long-term trajectory will be influenced by global trends like electrification and biofuel adoption. But for now, these regions represent some of the last strongholds of demand growth for traditional fuels, and it makes them a critical market for refineries and traders alike.
That's quite interesting. Now, what role does policy play in this shift? So, if we were to talk about the role of governments, are governments really accelerating or slowing down these changes?
That's a kind of a critical situation, Trisha, because, the government policy, they are one of the most powerful forces in shaping the energy landscape today. They are both accelerating and in some cases complicating the transition away from traditional fuels. So let's start with the accelerators. So many governments, they are implementing aggressive policies to reduce carbon emissions and promote cleaner energy. So for example, the European Union, it has set some of the ambitious targets to ban even the sale of new ICE vehicles by 2035. And if I have to mention Norway, they are even more ambitious. They are aiming to end ICE vehicle sales by 2025. So they are 10 years earlier than the entire European Union. So, these policies, they are pushing automakers and consumers toward electric vehicles, and it will help in turn to reduce gasoline and diesel demand. So, there are efforts there, but it comes with the cost. So these automakers, they have to move away from the traditional automaking, and the excess cost they will be getting, it has to be bear by the common vehicle buyers, unless and until there is a subsidy present in the market by government. Now let's talk about the biofuel mandates. They are becoming even more stringent. The EU's Renewable Energy Directive 3, for instance, I'm just giving a example. So it targets around 29% renewable energy share in transport by 2030. So this has led to a widespread adoption of, E10 gasoline and B7 diesel across Europe. So the US is also moving forward with tin gasoline, and China has ramped up biodiesel production to meet its own emissions goals. So these mandates, they are directly impact refineries, but they are kind of a cutting the market share of fossil fuels, specifically for gasoline. And having said that, let's talk about the complications. Not all regions are moving at the same pace, and we know that some of the policies, it create uncertainties, and we have some of the historical examples that some of the policies that has been created, but it remained very uncertain in the market. So in Europe, if I have to give an example, there is a growing resistance to strict ICE bans from the countries like Italy and Germany. They kind of argue that bans could hurt their automotive industries, because we know that top brands are coming from these particular countries. And Sweden's recently rolled back its greenhouse gas reduction targets for 2024 and 2026, slowing biofuel adoption. So in emerging markets, if we have to see, the picture is even more mixed, because many developing countries prioritize economic growth and energy affordability over environmental goals. So for example, in parts of Africa and Southeast Asia, subsidies for fossil fuels remains in place to keep energy accessible, and this slows the transition to cleaner alternatives and sustain demand for traditional fuels. And even the geopolitical factors, they also play a key role. For instance, the sanctions on Russian oil products, they have reshaped global trade flows, with the countries like Turkey and Brazil becoming major buyers of discounted Russian fuels. So these particular shifts, they can undermine global efforts to transition away from fossil fuels. And Trisha, the government policies are double-edged sword. On one hand, they are accelerating the shift to EVs, biofuels, and cleaner energy. And then on the other hand, uneven implementation, resistance from industries, and then geopolitical complexity. They create some of the challenges and uncertainties for refineries and energy markets. So the pace of change will ultimately depend on how consistently and effectively these policies are applied worldwide.
Now, Sandesh, talking about refineries, as the older refineries, they eventually shut down as the lifespan of their come to an end. So, what does that really mean for the global refining capacity? Are we looking at a surplus or a deficit in the coming years?
Well, that's a great question, Trisha. The global refining landscape is undergoing a significant transformation, and this has a major implications for refining capacity. So, whether we are looking at a surplus or deficit, it depends largely on where you are standing geographically. So, if I have to give a detailed description, Let's start with the closures. So we have a mature markets and then immature markets, or kind of a developing markets. So in mature markets like Europe and North America, older refineries, they are shutting down, and it is an accelerated pace. So these facilities, they are often less efficient and they are more expensive to operate. So every refinery has a cost and they have to operate at sustainable cost and even gain some of the profits. So eventually they call it as a refining margin. So if you have a very very low refinery margins or negative refinery margins, then economically your refinery is not kind of allowed to operate, or it is more expensive to operate, and they are not able to compete with the newer or more advanced refinery, because the product prices, they have to be compatible or they have to compete with the newer refineries. So for example, if I have to give, Europe has seen a major closures recently, and if I have to give a significant examples, those include Petroineos, they are converting its Grangemouth refinery into terminal, and then Shell is also shutting down its vesseling plant in Germany. Also in the US, we have seen facilities like Lyondell Vessels Houston refinery, and then Phillips 66 Los Angeles plant. They are also set to close. So it's not just developing markets, but developed markets like one of the major refining markets is US, and even there is also refineries getting closed. The reasons for this closures are clear: declining demand for traditional fuels, then stricter environmental regulations and the policies, and at the same time, high cost of upgrading aging infrastructure to meet modern standards. And if this trend is reducing refinery capacity in these regions, which are increasingly relying on imports to meet their needs. So we have one effect where refineries are closing, and these particular regions started importing some of their needs via global markets. So that was about the closures, and now let's talk about the expansions. So in contrast to the closures in the mature markets, we are seeing significant new capacity coming online in Asia, in the Middle East, and even in the Africa. So these regions are building modern, high efficient refineries that are designed to meet both local demand and export opportunities. So, for instance, we have talking a lot about the Dangote refinery in Nigeria in our previous podcast. So, this Nigeria refinery, the Dangote refinery, it started operating in the mid of 2024, and it is one of the largest in the world, which has capacity around 0.65 million barrels per day. And it is expected to not only meet Nigeria's domestic needs but also export refined products to other parts of Africa and beyond. So, Trisha, this particular refinery, even if it is commissioned in mid 2024, it is still not be able to work in its complete capacity, that is 0.65 million barrels per day. And once it is running in on that particular capacity, we see major trade flows shift from West Africa to European region. And adding to that, similarly, we have a Yulong refinery in China and then Dakam refinery in Oman. They are also adding substantial capacity to the global market. So, there are several different refineries, those are coming into the market. I have mentioned few because they are the important ones. And the trend is like that now OPEC countries, those are kind of a exporter of crude oil. Now they are venturing into the refining business. So we have seen in the recent years, big refineries, they are coming in online in OPEC or OPEC plus countries. So important effect is that this particular refining sector is getting shifted from India and China to this particular, but that was not a major shift. A small shift will be there, but yes, the trade will be shifted from these particular OPEC plus countries. So the net result is a geographic shift in the refining capacity. While Europe and North America, they are reducing capacity, at the same time Asia and then the Middle East and Africa, they are increasing theirs. So this is creating a surplus in some regions and deficit in others. So overall, if I have to say, they are maintaining balance, but on the other hand, we are seeing a surplus in capacity if we consider the global shift or the global overall capacity. Globally, we are like to see a surplus in refining capacity over the next few years. So the IEA, they projected that global throughput will rise around 83.4 mbpd by 2025, and it may be driven by around 1 mbpd by mainly from the non-OECD countries, that is, India, China, and others. However, this surplus is concentrated in export-oriented hubs, while regions like Europe may face a localized deficit and increasing reliance on imports. So finally, I will like to conclude with following remark, and hear me carefully. The refining landscape is becoming more fragmented, and we are moving toward a world where modern refineries in Asia, the Middle East, and Africa dominating the market. So while older facilities in the Europe and North America struggle to stay relevant or shut down entirely. So this shift will have profound implications for trade flows, and then we have implications for tanker demand as well as the global energy markets.
You are absolutely right, Sandesh. Now, you mentioned earlier about modernization. So, could you elaborate on what are the various technologies or different strategies that the refiners adopt to stay competitive in the market?
Certainly, Trisha, the modernization is crucial for refiners and for the refineries because it makes them to remain competitive in today's rapidly evolving energy landscape. So, if I have to give some of the key strategies and technologies that refinery are adopting, let me break down this. So, there are several factors those are impacting these strategies. So, first factor is energy efficiency. So, you know what? One of the most immediate and impactful steps refineries are taking is improving energy efficiency. So, refineries consumes a significant amount of energy, and so even a small improvements it can lead to a substantial cost savings. So we have many facilities inside the refineries, and these facilities they are upgrading their equipment to reduce energy consumptions. So if I have to give example, then we have advanced heat exchangers, then we have optimized distillation columns and high efficiency boilers. They are becoming standard, and you know what? The refineries are also implementing digital technologies like AI and machine learning to monitor the operations in the real time and identify efficiencies. Predictive maintenance is another area where digitalization is helping refineries. They can reduce some of the downtime and operating costs. So, to some refineries, they have kind of a infrastructure present where heat needed, and if you reduce this particular heat, you able to maintain your energy consumption below the average of what other refineries are consuming, and for that you need some of the upgradation or change in your infrastructure. It is a costly, but in a long term it will benefit to remain competitive. The other important factor is the biofuel production. The shift towards renewable energy is pushing refineries to diversify their product slate. So many are investing heavily in biofuel production to meet growing demand and then regulatory requirements. So Trisha, many countries we have seen some of the mechanism where refining company is a distributor company also. So in that particular case, what is happening? Some of the fuel these companies or these refiners are producing, they need to be blended so that they can get a higher margin, as well as they can comply to the policy that particular government is optimizing. And that is why this biofuel production came into the picture, because then this particular refinery they produce traditional fuel and then they can blend it with their own biofuel with their hand, and by that way they can increase their refinery margins, and at the same time they can remain competent with the other modern refineries. So if I have to give an example, for instance, some of the they are being converted into biorefineries, not fully, but some infrastructure they convert into biorefineries, because these facilities they produce renewable diesel, biodiesel, and the sustainable aviation fuel from the feedstocks like vegetable oils, animal fats, and the waste products. So a notable example is Neste. It is a Finnish company, and they transformed into one of the world's largest producer of renewable fuels. So co-processing is another approach in this particular method. The refineries, like I have mentioned earlier, they blend bio-based feedstock with the traditional fuels and during the refinery process, and this allows them to produce renewable fuels without completely overhauling their facility. So that was the second, and third one is the important one where the entire Indian industry is lying upon is O2C integration, that is petrochemical integration. So as the demand for traditional traditional fuels like gasoline and diesel declines, refineries are shifting their focus to petrochemicals, which are used to make plastics, chemicals, and other industrial materials. So petrochemical integration, it involves, kind of upgrading refineries to maximize the production of high value chemicals like we have ethylene, then propylene and aromatics, and even some of the higher products from this particular segment. So these products, they are less affected by the energy transition, and at the same time they have a strong demand growth, and the demand is specifically coming from the emerging markets where these particular products are the key for them to utilize into their domestic industry. So refineries in Asia and the Middle East, they are leading the way in this area. So for example, the new Yulong refinery in China and then the Duqm refinery in Oman, they are designed with the petrochemical production as a core focus. So this dual purpose, their approach makes them more resilient to changes in fuel demand. So even in India also we have seen some of the PSU refiners, or not even PSU, we have seen Reliance and then Naira refinery. They are also working on the expansion, and the expansion will be focus towards this O2C integration. So the fourth one is carbon capture and storage. So to address environmental concerns, some of refiners are investing in carbon capture and storage technologies. We call it as a CCUS, and CCS systems, they capture CO2 emissions from refining process and then they store them underground, and then they use that particular CO2 for enhanced oil recovery. This particular method is still in early stages, and it's even costly. But in future, if the cost is reduced, then it can be a vital tool for reducing the carbon footprint in the industry. So renewable energy integration is another approach where refineries, integrating with the renewable energy sources like solar and wind into their operation. So with that, they will reduce their reliance from traditional electricity and shifted their reliance to the renewable electricity. So this help them to reduce their fossil fuels reliance, but also helps them to meet kind of a sustainability goals. Now every refinery or major refineries, they are having kind of a sustainability goals, and if this particular integration they will set up, they will achieve these sustainability goals. So for instance, in the Middle East, there are several refineries. They are now partially powered by solar energy, and by that way, they are leveraging the region's abundant sunlight. So one of the specific example can be Oman, where we have seen large solar farms. Those are in the desert and capturing solar energy, and that particular solar energy they are using into different industries. They use that particular solar energy even for the oil production in the enhanced oil recovery, and now they are also starting using that particular solar energy into refinery business. So there are abundant opportunities for the refiners to change their strategy and to gain certain momentum in the market. But important thing is that they also have to save significant cost. So renewable energy is always a key goal for refiners to move and achieve sustainability goals, but at the same time they also have to manage the cost, and as long as this specific integration is cost effective, they will going to implement it. Otherwise, then it will remain as early stages, or refineries will not be looking for such kind of solutions in future if they are more costly. Final and the important one, which is a kind of a key for global industry or global refineries in the world, and it is the production of hydrogen, and hydrogen is a kind of a area of focus for refineries. Also, it is still in early stages, but refiners are keen to go for the producers and even consumers of hydrogen, because hydrogen can be used in the production of petrochemicals. At the same time, a refinery itself can produce hydrogen, and then the excess hydrogen they can also sell to the global market. So hydrogen, if refinery is producing, it is certainly gray hydrogen. But then we have green hydrogen. Again, it is producing from renewable energy, and it is gaining traction nowadays. And it can be used both as a feedstock and as an energy resource within refineries, and it can further reduce emissions. So these are the strategies I think refineries can build on, and they should focus on in the longer term. But they also have to look for the cost occurred for implementation of these particular strategies.
Thank you, Sandesh, for that elaborate explanation. Since you talked about strategies and technologies, but what about profitability? Can refiners still make money in this challenging environment?
The profitability in today's refining industry, it is undoubtedly more challenging, but it's not an impossible one. So refiners, they are finding a ways to adapt and carve out opportunities despite the headwinds. So let me break this down. So we have a kind of a pressure on margins. So first it's important to acknowledge that the refining margins, they have come under significant pressure. The extraordinary profitability we saw during 2022, it was driven by kind of a supply disruption and geopolitical shocks, that has faded. So margins like the 3 to 1 crack spreads, which measures the profitability of turning crude oil into gasoline and diesel, it have normalized to pre-pandemic levels. We have seen during pandemic the profitability went down, and that was because the demand was actually not there. So, for example, situation in Europe, margins, they dropped from $23 per barrel in 2022 to under $16 per barrel in 2024, and that was around a $7 drop within 2 years. So, in some cases, they have dipped even lower. It forced refineries to cut runs or shut down entirely. So, this decline is largely due to weaker demand in mature markets, due to rising biofuel mandates and increasing competition from newer and more efficient facilities in Asia and the Middle East. So, as a refiner, what you will do? Either compete with these particular refineries and have a higher cost, and then if you are not getting margins, the only option you will have to either cut the runs for some specific time or you shut the entire refinery down. So that is why refiners are more focused on margin, and today's environment is that there is pressure on margins due to global change and this efficiency in new refineries. The other aspect of it, the role of export oriented refineries. So now we have a two type of refineries. One, for instance, those are particularly designed to cater domestic industries because lack of challenges are there in terms of infrastructure, because these particular refineries, they were designed in such a way that they will never export globally, or even if they will export in the future, the export will be very very minimum. So specifically talking, we are seeing some of the refineries, those are kind of a landlocked refineries. They were getting crude from the nearby places, refining it, and supported domestic market. On the other hand, we have export oriented refineries. Those are designed in such a way that they will always focus on export oriented material or export oriented products. Those are high value products. So the despite the challenges, export oriented refineries, they are still finding ways to remain profitable. So these are large modern refineries or facilities. They located in the regions like Middle East, Asia, and those are specifically designed to serve global market. So kind of an example, if I have to give from the Indian perspective, we have a Reliance, then we have a IOCL refineries. At the same time, we have a Naira refinery. So those refineries are there. Those are export oriented refineries, always focused on exporting their material to the global market. For instance, Duqm refinery in Oman, they are kind of examples of facilities that can produce refined products at lower cost, due to their scale, efficiency, and access to cheaper crude. So this Duqm refinery, it is located nearby the crude reservoir. So at the same time, they are getting cheaper crude because their transportation cost is almost zero. Second thing is that they have a kind of a cheaper access to it, because whatever material they were having, it is always available to them in terms of storage, and it is located nearby the refineries and the scale of refineries. So these particular refineries, they are producing products on a massive scale, and it is going to help them to maintain their efficiency, and at the same time to help to maintain the margins. So these refineries, they are targeting emerging markets in Africa, Latin America, and Southeast Asia. So here demand for fuels is growing. That's why the export oriented refineries, they will get market momentum from these particular geographical areas. So by focusing on a long haul exports for to these regions, the refineries, they can offset the declining demand in traditional markets like Europe and Northern America. The other and important factor for profitability is the focus on niche markets and specialty products. So refineries should focus on specific high value products because they kind of have a significant demand from the international markets or the global markets, but at the same time they are also getting premium on these particular products. So refiners, they get a premium for these particular products. At the same time, their production cost and their production margins, it's also higher in while producing these particular products. So refineries, they can stay profitable if they target in some of the niche markets, or they can produce some of the higher value products. So for a refinery, instead of focusing solely on fuels like gasoline demand and diesel, nowadays many refineries, they are shifting towards petrochemicals, lubricant, and at the same time specialty chemicals. So petrochemicals in particular, they have a strong demand growth, specifically in Asia, where industrialization and urbanization, they are kind of driving consumption. So by integrating petrochemical production into their operations, the refineries can diversify their revenue streams and kind of reduce their reliance on traditional fuels. At the same time, what I think is refineries, they should focus on seasonal and regional opportunities, because we all know that profitability can also vary by season and region. Because, for example, during periods of high demand, such as kind of a summer driving season in the US or winter eating season in Europe, the margins can temporarily improve, and the weather, it can play an important factor in the demand supply segment. So refineries that can quickly adjust their output to meet their seasonal demands, they can capture short-term profitability spikes. And we have now refineries, those are the modern refineries, they have such a mechanism present where they can quickly adjust their output from one product to other. Additionally, the regions and the regional factors, they also kind of play a key role, because refineries in countries with access to kind of a discounted crude, such as Russian or Middle Eastern oil, and even they can maintain better margins compared to those reliant on higher priced imports. So we have countries like India, China, Turkey, and others. They can get discounted crude and then process it and increase profit margins. So even refineries nowadays, they kind of do hedging mechanism, and with that they can also reduce the importation cost or the procurement cost on crude, and this is how they are playing in the market. So big refiners, specifically in China, as well as some traders, they help each other with respect to increase in profit margin. The other one is cost management and modernization. So cost management, it's kind of a generalized term, because every cost or every dollar that has been saved, it is earning for them. So refiners, they need to invest in such a program like energy efficiency, digital technologies, advanced processing. It can lower their operating cost and improve their competitiveness. So for example, AI driven systems, they can optimize operations, and predictive maintenance tools to help reduce downtime and increase profitability. So not even AI, but we also have solutions. We can say that drones and other technologies, they can monitor several different units in the refinery and can suggest early maintenance, or they can define some of the maintenance prior to that has been scheduled. So to sum up, refinery, they have to manage in terms of profitability in such a way that investment should be there, but at the same time they should also focus on demand supply patterns, regional patterns, and sourcing of crude.
That's definitely a lot to consider, from the refiner's perspective. But let's also talk about the environmental side. So, Sandesh, could you tell us how are refiners balancing this profitability with the need to reduce emissions?
So we have talked about the profitability. Now balancing profitability is what we need to balance profitability in terms of environmental spectrum. We need to reduce emissions because it is a complex challenges for refineries. So on one hand, we have refineries. They are under increasing pressure from governments, local authorities, regulators, and sometimes even consumers. They have to direct their producers to follow particular pattern or follow particular regulations to reduce their carbon footprint. On the other hand, refineries, they must remain profitable in a highly competitive market. So to address this, many refineries are focusing on decarbonization technologies, and at the same time they should reduce the overall environmental impact of their operations. There are a lot of different technologies and lot of different fundamentals present in the current market environment to reduce emissions with the help of digitalization and all those technologies. Everything has a cost associated with it. So at the same time, refineries also need to balance that particular cost. The upfront capital cost for CCS infrastructure, it can be substantial, and the ongoing operation cost can also be a high. So additionally, the economic returns from such investment, they are often slow to materialize, and that makes it difficult for refineries to adjust or to justify the expense in the short term. So some refineries, they are turning to government incentive and kind of get carbon credits or renewable credits. It helps them to offset some of the cost, but on a larger spectrum, this doesn't fully solve the financial equation. So at the same time, there is a growing focus on alternate energy sources and even improving energy efficiency. So ultimately, it's a matter of finding the right balance between short-term profitability and long-term sustainability. So the transition to a low carbon capture is inevitable, but it requires significant investment and strategic planning.
You're absolutely right, Sandesh. I guess we'll have to wait and see how the refining industry will change and adapt as time goes by. And with that, I guess I'd like to end our part one on our discussion on refining. It was really great to have an enlightening discussion with you.
Thank you, Trisha. Always happy to be here and to discuss more with you guys.
And to all our listeners, I hope you've gained valuable insights into the challenges and opportunities as we were discussing about the refining segment. And with that, I'd like to ask you all to stay tuned for part two as we'll be discussing on shipping. So until then, don't forget to subscribe, share, and join us for our next episode. Until next time, stay informed and stay inspired.